Joe, always good to see you. Thanks so much for joining me.
Thank you. Very good to be with you, Jennifer. Happy holidays.
Happy holidays to you. And what a way to kick off the holidays with such a stellar third quarter GDP number, up 4.3%, a full percentage point above expectations, and driven by consumer spending up 3.5%, though a large chunk of that from healthcare spending. Though we also saw trade really add to this number as well. Joe, can we see this level of growth sustained into next year?
Yes. Let me say this. You mentioned the consumer, talk about healthcare. Healthcare was up a lot, yes. However, consumer goods, spending in real terms up over 3%, recreation up around 7%, transportation up, I also believe around 7%. You had a big gain in other consumer spending services. So the gains are very broad based. That dovetails with all the anecdotes post the holiday shopping season, Black Friday, et cetera, that show huge spending. And let's not forget CapEx, which grew over 5%, and the fact that exports were up nearly 8%, and the trade deficit, thanks to President Trump's policies, are shrinking massively. What we have, Jennifer, right now in the fourth quarter potentially is an economy that's growing at 3%, according to the widely followed Atlanta Fed. If that number is correct, that will put us at just a smidgen under 3% for the year, which is remarkable. So we could definitely do 3% type GDP growth, maybe more. We saw that in the first Trump term, and these data were a 10 out of 10 this morning.
To your point, Joe, on the business investment, we saw that slow a bit to 2.8%, and ordinarily that would have been really strong. Of course, that's coming off, 7% from the prior quarter. But also with all of this AI data center build out, something that caught my eye was that investment in non-residential structures contracted at a 6.3% pace. What do you think was going on there? Is this sort of an ebb and flow, an anomaly here? Should we be reading
Well,
into this at all?
I'm happy you mentioned that because the number that I cited was for equipment spending and software spending. That was over 5%. On the structures, that's very weak. Some of that could be due to just waiting to see what the guidelines look like for the full expensing of factories, which is part of the one big beautiful bill the president got done in record time. Data centers are not part of that. People are overestimating the AI effect on the GDP numbers because a lot of the spending is business to business, which is actually not part of GDP. But if you're asking me why I think structures are so soft, it's the same reason why residential investment, which was also negative in today's report, was soft. It's because interest rates are too high. Yes, the economy is booming, but this is a disinflationary boom, a disinflationary capex boom tied to President Trump's supply side pro-growth deregulatory policies, and therefore interest rates need to come down. If interest rates come down with the expensing we've got for the factories, we will build a whole lot more next year, Jennifer. That'll be high-paying construction jobs. All the capital that will go into those new buildings, that will be fully expensed. And of course, the workers that will be there, because manufacturing pays higher than average wage rates, will have really nice incomes, really fat paychecks.
Yeah, I want to come back to that point on jobs, but you brought up the lower interest rates, Joe, and we saw the stock market wavering a bit earlier today because they thought, oh, strong GDP means no Fed rate cuts next year. And we saw the president acknowledge that in a post on Truth Social. And he says, look, anyone who tries to basically stagger this rally by raising rates or holding rates steady, like, I don't want them as my Fed chair. You think the Fed can continue to lower rates next year if the economy sustains a 3% growth pace?
Yes, because if the economy is growing at 3% because potential supply is increasing, that means lower inflation, and the Fed could accommodate that because if real rates are rising as inflation is falling, monetary policy is actually getting tighter. Right now, Jennifer, the yield curve is still very flat, meaning when you have easy money, the yield curve is steep. There's a big spread between long and short rates. That's not the case. The dollar would be a lot weaker. That's not the case. In real broad-weighted terms, the dollar is extremely high, and inflation expectations are incredibly well contained. They're basically predicting 2% inflation, which is price stability. So the Fed can continue to lower rates. The Fed should lower rates based on its own estimates of where R star is, the neutral rate, and based on the fact that interest-sensitive activity is still extraordinarily weak, and that's where monetary policy has the most impact, are those interest-sensitive sectors.
With such a strong print on the economy, why do you think we've seen a softer job market. Typically, we have not seen that. Some people have suggested there is a decoupling now between GDP and employment. I sort of scratched my head on that one. Do you think this is sort of temporary? And to your point, maybe this is, I don't know if it's uncertainty or whatnot, but we could see a resurgence in hiring next year.
It's
Oh, go ahead.
Sure. It's temporary, Jennifer, because there are lags. The economy recovers and it takes a little bit of time. It doesn't happen instantaneous where you get the jobs. What we saw over the prior 4 years under the prior administration was record government spending, which effectively gave the economy a sugar high and boosted the labor market. What we know after the fact with revisions, jobs have been revised down nearly 2 million workers in the 2 years prior to President Trump taking office. So the labor market was massively weakening. Given the private sector gains we're seeing in GDP, which, by the way, no one I see has talked about this, if we take the government out of the GDP accounts, the last 2 quarters have seen annualized real GDP of 4.7% growth. That will lead to hiring and it will lead to high paying jobs that will accompany that fast acceleration. So the jobs will come. We have seen the 3-month moving average on private employment go higher. My expectation is based on the numbers we're seeing, the pro-growth policies, which haven't even really affected the economy in a full capacity yet, will lead those employers to hire. And this puzzle, as you said, between the strong GDP and low hiring will come together with employment rising to the GDP.
And to your point, before I let you go, we've got this strong GDP number. You've painted a strong picture ahead. Yet the consumer sentiment number out this morning for December showed that consumers have soured to a level that we haven't seen since April. A lot of people feel like things are very expensive now, but if we were to see more job growth, higher wages, as you have painted, would that not help the affordability issue? Do Americans need to be, for lack of a better way of putting it, a little more patient here, perhaps, until the middle of next year?
American families have suffered mightily over the past 4 years. Living standards collapsed under the prior administration. And yes, it will take time, but the good news is that the policies the president has put in place, in particular the no tax on tips and overtime, will significantly raise after-tax wages next year. We've seen, Jennifer, through November, real blue-collar wages, which is in the establishment data, as it's known, I'm getting wonky, the non-production supervisory workers up 1.6 year to date. That's one of the biggest increases in 60 years to start a new administration. So we just want patience just because things are getting better. But we understand people's frustrations. The confidence numbers are weak. Partly, I think that reflects maybe bad polling. I would say it matters more what people are doing than what they're saying. But if the economy continues to evolve, and we've been saying this for a while, the secretary has been very clear, 3% growth this year was very doable. When nobody thought that was the case, then people are going to be very happy as we get into 26 and beyond. And a lot of these numbers will also improve.